Dear colleagues, ladies and gentlemen of the media, thank you for joining us today as we present the last Monetary Policy Committee statement of 2011, which has indeed been a momentous year. The schedule of meetings for 2012 is attached to the printed statement and will also be placed with the statement on the SARB website for ease of reference. Since the previous meeting of the Monetary Policy Committee, there has been no meaningful progress to resolving the sovereign debt crisis that is engulfing the euro area, with a primary focus now on Italy and Greece. Therefore, it can no longer be referred to simply as the periphery. The interlinked nature of the debt crisis and the concerns about the banking sector in Europe, coupled with the inability of the advanced economies to generate sustained growth, continues to weigh negatively on the global economic outlook. The heightened uncertainty has had implications for the pattern of global capital flows and exchange rates in emerging markets. The domestic economic recovery remains hesitant. The relatively weak economy has ensured that demand pressures on inflation are restrained at this stage. Nevertheless, exogenous supply-side factors have resulted in a deterioration of the inflation outlook, with a more protracted breach of the inflation target expected in 2012. The year-on-year inflation rate, as measured by the Consumer Price Index for all urban areas, increased to 5.7% in September 2011, up from 5.3% in August. The categories of food, housing and utilities, and transport together accounted for 4 percentage points of the September outcome. Food price inflation accelerated from 7.3% in August to 8.7%. Petrol and electricity prices increased by 26.2% and 17.3% respectively. Administered price inflation excluding petrol was unchanged at 8.8%. CPI inflation excluding food, petrol and electricity remained unchanged at 3.8% in September. Year-on-year producer price inflation continued its strong upward trend, increasing to 10.5% in September from 9.6% in August. These price developments were strongly influenced by global commodity price movements, as well as by the depreciation of the rand exchange rate. Price increases in the categories of mining, electricity and products of petroleum and coal, as well as other manufacturers, remained the major contributors to the PPI outcome. Food prices also continued their higher trend, with agricultural prices increasing by 10.7% and manufactured food prices by 8.8% in September. The inflation forecast of the bank showed a modest increase since the previous meeting of the MPC. Inflation is expected to breach the upper end of the target range in the final quarter of 2011 and to peak in the first quarter of 2012 at around 6.3%, before declining gradually and returning to within the target range in the final quarter of 2012. Inflation is expected to measure 5.2% in the final quarter of 2013. The bank's forecast of core inflation, which excludes food, petrol and electricity, continues to show a moderately rising trend, with a peak of around 5.2% expected in the first quarter of 2013. Market expectations of inflation, as reflected in the Reuters survey of financial analysts, show expectations to be anchored around the upper level of the inflation target range over the medium term. In the October survey, inflation was expected to peak at an average of 6.1% in the first quarter of 2012 and to measure 5.4% in the second quarter of 2013. Break-even inflation rates have moderated against most maturities since the previous meeting. The global growth outlook continues to be characterized by heightened uncertainty with weak growth and declining consumer confidence in a number of the major advanced economies. The protracted crisis in the euro area has now spread beyond the peripheral countries, despite recent attempts to devise a credible and workable approach to contain the problem. The risks created by these developments are likely to exacerbate the low or negative growth expected in the region, amid increased fiscal austerity, tightened bank lending standards and deleveraging, as well as a tightening conditions in the European interbank markets. Weak growth is also forecast for the UK and Japan. On the positive side, fears of a return to recession in the United States have dissipated somewhat, with a higher-than-expected growth outcome in the third quarter, driven mainly by a recovery in household consumption expenditure. Although employment increased in the past quarter, the unemployment rate is expected to remain at elevated levels for some time, along with persistent weakness in the housing market. Growth in many of the emerging markets has moderated during the year. Growth forecasts have generally been revised down and are sensitive to developments in the advanced economies. China has experienced a policy-induced slowdown, but fears of a possible hard landing have receded somewhat. Significant growth reductions have been experienced in a number of Latin American and emerging European countries. Headline inflation appears to have peaked in many of the advanced economies, and is expected to moderate in line with declining economic activity and the softer trend in commodity prices. Inflationary pressures remain at elevated levels in many of the major emerging market economies. The exchange rate of the rand continues to be subject to changes in risk aversion in global financial markets. Since the previous meeting of the MPC, the rand has fluctuated between 7.70 Rand and 8.50 Rand to the US dollar, but has generally traded in a more narrow range of between 7.80 Rand and 8 Rand. On a trade-weighted basis, the rand has depreciated by around 18.6% since the beginning of the year. Since the last meeting of the MPC, the rand has in fact appreciated by 1% on a trade-weighted basis and by 1.4% against the US dollar. Although the rand tends to be more volatile than most of its emerging market peers, the movements of the currency have been in line with other emerging markets and commodity-linked currencies. The exchange rate has also been influenced to some extent by volatile capital flows. Non-residents have been persistent net sellers of South African equities for most of 2011, with cumulative net sales since the beginning of the year amounting to 16.6 billion rand. Between April and August, non-residents were net buyers of bonds to the value of 58.4 billion rand, but as the European crisis has intensified, net sales of 17 billion rand were recorded in September. In October, this trend was reversed somewhat, with non-resident net purchases of 9.8 billion rand. Year to date, net purchases of bonds and equities amount to 29.4 billion rand. The uncertainty related to the exchange rate imparts an upside risk to the inflation outlook. However, unless the rand continues on a depreciating trend, the impact is likely to be relatively limited and should dissipate in the short to medium term. While the rand is not expected to return to its previous elevated levels, consensus forecasts indicate an expectation of a moderate appreciation from the current levels during the course of 2012. This is largely dependent on global developments. The slower domestic economic growth in the second quarter of 2011 appears to have continued in the third quarter, and the forecast of the bank has been subject to downward revision. Real GDP growth in 2011 is now expected to average 3%, compared with 3.2% in the previous forecast. The growth forecasts for 2012 and 2013 have been revised down to 3.2% and 4.2%, from 3.6% and 4.4% respectively. The downward revision is a result of revised assumptions primarily of international commodity prices and global growth. The composite leading business cycle index of the bank continued the moderate downward trend that began in February. It decreased for the second consecutive month in August, corroborating the expected restrained economic conditions. There has been some normalization of manufacturing activity following the widespread industrial action in July. The physical volume of manufacturing output increased at a year-on-year rate of 7.7% in September, following the revised 5.9% increase in August. On a quarter-on-quarter basis, a slight contraction of 0.1% was measured in the third quarter. Despite the recent recovery, the Kagiso BER Purchasing Managers Index remained marginally above the neutral 50 level in September and October, in line with subdued global PMIs. Mining output has continued its overall downward trend, with the physical volume of mining output declining by 5.1% on a quarter-on-quarter basis and by 5.4% on a year-on-year basis. The construction sector remains under stress, with the FNB BER Civil Construction Index declining further in the third quarter. Despite the disappointing growth outcomes, the quarterly labour force survey published by Stats South Africa indicates that the number of people employed increased by 195,000 in the third quarter of 2011. The prospects for further employment creation are uncertain, given the slowing growth of the domestic economy and the fragile global economic environment. Growth in consumption expenditure by households is expected to have remained relatively subdued following its moderation in the second quarter of 2011 to 3.8% from 5.2% in the previous quarter. When comparing the 3 months to August with the previous 3 months, real retail sales, trade sales increased by 0.7%. The BR Retail Survey for the third quarter of 2011 shows that business confidence among retailers at a level of 48 remained below the neutral level of 50. These trends reflect in part concern about employment, slower wage and income growth, and declining levels of consumer confidence. Other factors expected to constrain consumption expenditure include high levels of household debt, constrained access to credit, and consistently above average increases in a range of administered prices, which reduce the amount available for household discretionary spending. Growth in credit extension to the private sector remains lackluster, reflecting both supply and demand considerations. After reaching a recent high of 6.1% in July, 12-month growth in banks' total loans and advances extended to the private sector moderated to 5.3% in September. 12-month growth in mortgage advances declined to 1.9%, consistent with the subdued state of the domestic housing market. The main driver of credit extension was the category of other loans and advances, in particular general loans, which grew at a rate over 12 months of 12.9%, down from 17.9% in August. General loans account for 11% of total loans and advances to households. The ratio of impaired advances as a percentage of gross loans and advances of banks has declined to 5.1% in September 2011, down from 5.9% in September 2010, indicating some improvement in the balance sheets of the banks. According to the medium-term budget policy statement, fiscal policy is set to be more expansionary than indicated in the main budget in February. Nevertheless, the commitment to medium-term deficit consolidation remains. For the current fiscal year, the deficit is expected to increase from 5.3% of GDP to 5.5%, compared with the 4.6% deficit recorded in 2010-11, and is expected to decline to 3.3% of GDP by 2014-15. The wider deficit for the current year is a result of a 0.7% of GDP increase in expenditure and lower tax revenues of 0.3% of GDP, which result from the slower economic growth. The primary deficit is expected to decline from 2.9% of GDP in the current year to 0.5% in 2014-15. If maintained within the parameters as set out in the medium-term budget policy statement, the fiscal consolidation and debt dynamics should be sustainable. Food prices continue to pose an upside risk to the inflation outlook, and a further acceleration of food inflation is expected in the near term. This follows the marked food and agricultural price increases at the PPI level and the depreciation of the exchange rate, which has contributed to the increase in maize prices in recent weeks. Global food prices have remained relatively stable over the past months, albeit at high levels, and could signal some relief going forward. International oil prices have remained relatively stable since the last meeting of the MPC, and are expected to remain constrained by the weak growth outlook in the advanced economies. At current prices, Brent crude oil is about $10 per barrel lower than the peak prevailing at earlier in 2011. Currently, there is a small over-recovery on the domestic petrol price, and, if maintained, could provide some relief to consumers following 4 consecutive months of price increases, which has resulted in domestic petrol prices being at the highest levels ever. Other administered prices, particularly electricity, are expected to maintain upside pressure on the inflation rate. The Monetary Policy Committee remains of the view that the underlying inflation pressures are of a cost-push nature, and that the subdued state of domestic demand and output will contribute to core inflation remaining contained. notwithstanding the continued pressures from some administered prices. However, the committee is concerned that the change in the profile of the inflation forecasts and the extended breach of the upper end of the inflation target range may impact adversely on inflation expectations. At this stage, the breach of the upper limit is still expected to be relatively small, and inflation is expected to return within the target range by the end of 2012. The committee assesses the risks to the inflation outlook to be on the upside, mainly due to cost-push pressures. The exchange rate is also seen to pose some upside risk to the outlook, while downside risks are seen to come from possible contagion effects from the European crisis and the associated slow growth. The committee is aware of the dangers of a disorderly resolution of the crisis and the systemic implications for the global and domestic economy, and remains ready to act appropriately should the need arise. Under the prevailing circumstances, the MPC has decided to keep the repo rate unchanged at 5.5% per annum. Thank you. It's open to questions and comments. If I can ask you to identify yourselves.
Good afternoon, Governor. It's Renee Fulgra from Sunday Times, Business Times. I would like to know whether the MPC discussed the announcement by Moody's yesterday and their outlook on our possible growth forecasts for the next years.
Obviously, the decision by Moody's to put South Africa on a negative outlook is something that we discussed and are concerned about. In terms of the approach, we would really feel that between now and the next steps from the fiscal side, which would be around the budget, we need to engage, we need to discuss, we need to understand their thinking better, and we will certainly do what we can in that regard. Miriam.
Thank you. Good afternoon, Governor. It's Mariam Issa from Business Day. Was there much debate about a rate cut at this meeting? And what was the main reason why you decided to keep rates unchanged?
I thought I've just spelled out all the reasons why we decided to keep rates on hold. Yes, there was, but the decision to hold was unanimous. There was no disagreement or having to persuade anybody, because we do work towards consensus. Everybody was agreed that the appropriate stance at this point in time was to hold. But of course, this is, as I've said before in the meetings, this is not an easy decision. We come there and we debate very vigorously what is happening, how we see it, and certainly there was discussion about whether a rate cut was appropriate at this point in time or not. On the balance, we felt it was appropriate to hold, given all of the issues that are prevailing, particularly globally, and to see where this leads to. So a unanimous decision on hold, but certainly a strong consideration of whether we should cut or not. In addition, we need to recognize that inflation is out of the target for longer, and that is our primary responsibility as well. So it's a balance between issues, but the main focus was on what, if anything, we should do about a decision around cutting, but unanimous on hold.
Good afternoon, Governor. Nompremela Losiziba from Summit TV. Just to go back to your little bit about Europe and the systemic impacts there. If there is an implosion there, what sort of impacts do you foresee that having on South Africa?
Well, I don't think I can sit here and say if it implodes, this is what will happen to South Africa. First of all, I think we've tried to set out and I'm sure every one of you is watching it as well, just how serious that situation is. So it depends what happens, if it's orderly or disorderly. If you can, if Greece does come to some agreement about a unity government, which it looks like they're in the middle of talking about today. It depends on Italy's ability to pass the legislation, to get things on track. So there are too many ifs and buts to say what would the impact be. But if one had to say what are the channels, you would look at it through the banking sector, you'd look at it through the trade finance, you would look at it through capital flows. All of these things would be dependent on the nature of that crisis. in the end, the reasons for emerging markets receiving the investments they have not gone away. Those pension funds and everybody else who's come to emerging markets still need to make those payments and meet those liabilities. So I think it is a very difficult time. I think that you're having in Europe I'm not sure how much further the can be kicked, having kicked it to can. That you've got the Leaders' Summit now, where to? So I do think there's a huge responsibility on the political leadership in Europe and elsewhere at this point in time. But to give you how South Africa would be affected or impacted, I wouldn't be able to say. But certainly, I think if there is an implosion in Europe, which every measure needs to be taken to avoid, I don't think anyone would be unscathed. Yeah.
Afternoon, Governor. It's Franz Wild from Bloomberg. I do understand that it was a unanimous decision, but I was wondering how many members of the MPC possibly advocated for a cut. And if I could just ask a second question, I was wondering whether the ECB rate cut didn't influence your decision in any way, or to what extent it was raised in your discussions.
Let me start with the second question first. We look at all movements of rates from the central banks in the period between that MPC, the last MPC, and this one. Who has taken what decision? Has it been up or down? What has been their previous situation? So that the question of an ECB rate cut would not stand out in and of itself. I think the reasons for that and the politics around and the decisions around the European rate cut, you must ask the ECB. I think that it is for them to answer. Do we look at all of those? Yes. We do see who has acted in what manner. But we also then look at what is happening to their growth, what is happening to their inflation, so that you're not looking at whether they have simply raised or lowered rates. It's in the context of what is prevailing in their own countries, because all countries have very different conditions. And therefore, if you have a country that has been raising rates and decides to lower, is very different from a country that has not raised rates, because they may be normalizing or they're seeing their own circumstances. So I wouldn't say that the ECB cut was a deciding factor in our own decisions at all. I don't think that would be correct. In relation to how many people advocated a rate cut, none. Because, as I said, this was a unanimous decision about holding the position. So it wasn't like people said, I advocate. What we said was that there are a lot of reasons to consider a rate cut, but weighed against what the reasons for not making a rate cut. It was unanimous that we felt we should not. And as I've said to you before, each individual has the ability to put their views and arguments forward, but there was nobody arguing for a rate cut who had to be persuaded not to do that. Everybody was, and I think, as I said, the discussions were pretty unanimous in that there were very many reasons to look at why, as well as to look at why not. So if one can give you that sense of the discussions, which is, it's not having to say, oh, you're going in that direction, we persuade you otherwise. I think we were very clear about what would be in favor of a rate cut and what would not, and therefore our decision as I've conveyed it. I hope that answers all the questions on that one. Let me see if there's anyone else first, Miriam. I don't know if anyone would like to add on that or to anything else. Miriam?
I wonder if you could comment on the decision by Moody's to also change the outlook on South Africa's main 5 banks to negative. Do you think it was warranted by the reasons of systemic risk and so forth that they put out?
I don't know, Lesetja, if you want to answer that one specifically as being responsible for the bank supervision side of things, or perhaps add. But my own view is that our banks are very sound. Our exposures to Europe are really negligible in the overall scheme of things. We are one of the banking sectors that did not have the crisis and has not had a crisis. So for me, it would be, I'm not quite sure what they're seeing there, because that's not what we see. At the same time, there's no way that we would be complacent because, as I said in answer to the earlier question, one of the concerns in Europe is the systemic banking question that they need to deal with, and as you're aware, significant pressure being put on them to recapitalize and ensure Tier 1 capital at 9%. But our banks are already there. So, I think that for me would be something that certainly not our view of our banking sector. But Lesetja, perhaps you'd like to address that as well.
I think, Governor, you have covered well on the bank. I think just a reminder of how the rating process works is that there are sovereign ceilings that are set. So if rating agencies say that we are going to change the outlook on the sovereign, including the sovereign ceiling, it goes without saying that all the rated entities that are located in that particular country would then have their ratings also put under review or put on a negative outlook, as it is the case in South Africa. Is it justified? I think that, as we had said, we believe that we have got good fundamentals. We believe that our banking system is well capitalized, is well supervised, and that we will take it as it goes. I guess once you are put on a negative outlook, the next thing is a continuous process of engagement with the rating agencies. Just bear in mind that this is just a revision in the outlook, it's not a downgrade in the rating.
Governor, a question via the webcast from Peter Montalo. Real rates will now be more negative for longer with your higher CPI forecast. Do you have any worries that both monetary and fiscal policy will be looser for longer and the effect this might have on the currency? Thank you.
Our real rates are just around zero, slightly below. And Peter, I'm sorry you're not coming through. I did get your message that you're not able to come now, and I'm sure we'll be seeing you early next year. But yes, of course, we need to have a coordination between monetary and fiscal policy in terms of that they should reinforce the policies that we have. So, as we've said, if the medium-term budget policy statement and the fiscal position keeps to the terms that have been set, I think that is fine. As you've seen, that the fiscal policy is expansionary. And yes, monetary policy is looser than it has been, but our approach at this point in time is taking on the decision that we have focused on here is to hold our stance, but watch very carefully as to what is happening going forward. So certainly something that we're very conscious of. Nombolelo. No.
Governor, just wanted to ask you on the data on the foreign investors coming in and out of South African bonds and equities. How concerned are you about this ebb and flow that's taking place?
Can I ask Deputy Governor Manella to deal with that? It's his area.
Well, obviously, that is part and parcel of the way in which financial markets are subjected to changes in risk sentiment. And clearly, it is of concern because if you've got this volatility associated with these flows that impacts on other variables and makes, obviously, policy making quite difficult. But at this stage, given the settings in terms of the vulnerabilities that people are seeing, the lack of credible solutions with regard to the challenges that we're seeing in Europe and with regard to the global economy in general, it is to be expected that you see that volatility. But that's kind of the environment that we live in, heightened uncertainty, and that produces volatility, and we just have to live through that. But it is, of course, of concern. Yeah.
But maybe just a bit about the switch to bonds. Bonds rather than focus on bonds.
Well, of course, what we have observed recently, and particularly during the month of September when we saw significant outflows, we've seen that happening predominantly in the bond market. But since that episode, We have seen foreign investors returning to the bond markets, but depending on how people view things, you have these switches from time to time where the focus would be on equity outflows and inflows, or sometimes on bonds. But at the moment, we are seeing inflows again through October, and the first few days of November have similarly seen inflows to the tune of about 5 billion rands again.
Yes, Frans?
Governor, in the Moody's statement, one of the points they raised was pressures on the ANC in terms of policy. Also, we saw after today's ANC verdict regarding Julius Malema that the rand appreciated. Do you see? Do you think that the ANC has kind of answered Moody's questions in a sense?
I'm not sure when I became a spokesperson for the ANC. As far as I know, this is not what the central bank is about.
No, but in terms of the effect on the South African economy and reassuring investors, that's the point.
Yes, but that's, I mean, it's the questions that you need to ask. I can't really stand and speak for the ANC and whether its response to Moody's. It also asks the question whether the Moody's interpretation is accurate and what we would think about that. So I'm afraid that question is not really for us to answer in the central bank. I think that Moody's must engage with the political leadership of the country and address their issues. That's a different question for the central bank. Yes? Just use the other one next to you.
I know this is only going to become clear halfway through next year, but do you anticipate any rand impact from the Anglo-Oppenheimer deal?
I think perhaps, Daniel, you want to deal with that. I mean, obviously it depends what flows into the country from the initial numbers, and it still needs to have discussions around it, but from the initial numbers, they're saying they would keep some offshore, but there would be a significant percentage of that of the dollars that would come in. But perhaps you want to respond. If they come in, we would look at managing it like any other flows in.
Absolutely. There's not much to add to that. Of course, a lot will depend on the corporate structures in terms of the domicile of the various companies through which these share holdings are held. And so obviously we know that Anglo-American is London listed, and some of the De Beers entities are also offshore held. So an element of it is going to be technically transactions between non-residents, but the announcement has just been made. The transactions need to be bedded down, so there's quite a bit of time before one would actually expect to see those flows materializing in whatever form.
Any other questions? You sure? Anything that anyone would like to add? Brian, you're fine? You're fine? Thank you very much. Thanks for coming through. As I said, this is our last meeting for this year. Thank you for the support during the year. Have a very good Christmas, everybody. It's still very far away each day at the moment. We take one day at a time as things stand. But I hope you all have a very good break, and we look forward to seeing you in January. You do have the schedule for next year. And thank you again very much indeed.